So I'm not going to give you any advice on how to trade, but I am going to talk about trading in general. If you just want to listen in, that's cool. Does that make sense?
Yeah.
All right. Let me copy this. Okay. So if we take a look at the compounded average, I want to put something in context here. All right. If we talk about the compounded average growth rate, CAGR, for Bitcoin over about the past 10 years, you want to take a guess what the average annual rate of return is for Bitcoin?
It's extremely high. That much I know.
It's pretty high. All right. So it's the average, and this is just a mathematical average, is about 200% per year. That means on average, it's tripling. That's really high.
Yeah.
And it's done that for about a little over 10 years. Do you have any idea how many hedge fund managers would kill? They would literally sell their mother into slavery to get an average of 200% rate of return for a decade. No one has ever gotten that before. Let me say that one more time. No one has ever gotten that before. Now, do you think anyone who's an active trader could ever hope to gain that kind of performance? I know I couldn't. I definitely could not do that. I was
not unless you had a crystal ball.
Yeah, exactly. Yeah, exactly. You're Michael J. Fox in Back to the Future, and you literally bring back a newspaper, right? Every day, right?
Uh-huh.
So I want to put this in perspective of, do you really want to go the route of being an active trader where you have to look at the market sometimes on an hourly basis? And on the one hand, and risk, there's a lot of risk associated with trading. And it's not just about losing your money. You can lose your sanity. You can lose your confidence. You can lose your family. You can lose your life's fortune in trading. Okay. That's really important. Or you can just sit there, buy it, and sit back.
Right.
But there's risk associated with that as well. You have to have a stomach made of steel. Bitcoin has gone through at least 3 times when it has dropped 80%. An 80% drop is massive. Most people couldn't stand a 50% drop. Traders, professional traders, don't like a 2% drop. That's uncalled for, just god awful. When I say 2% drop, 2% on one trade, right? It's not uncommon for traders to go down 25% in their portfolio, right? That hurts. 50% is devastating. 80% will put you in the dirt, all right? So if you want to buy and hold, that's one way to go. If you want to get that 200% average annual rate of return, that's great, but you have to be willing to take the 80% drops, all right? You have to be willing to say, over the course of 2 weeks, oh, I lost $500,000. Yeah, that's interesting. Oh, look at that, I lost $250,000. Let's go have dinner. You have to really think about this. Trading, the one thing that, the most important lesson I learned as a trader is I had to learn who I am. And I had to know what my tolerance for pain is. I was able to go through those periods, and I've held Bitcoin for almost a decade now. I've held on to this position through all the ups, all the euphoria, and all the devastation 2, 3, 4 times now. And it sucks. It's like getting kicked in the gonads several times over a decade. It sucks, right? Because what am I telling people? This is the hardest form of money around. This is the most pristine asset ever created. And here it is, taking an 80% loss. I know it seems like I'm beating a dead horse right now, but I really want to put things in context for you. do you think you can do better than a 200% average annual rate of return? Number two, are you willing to go through all that pain? Because that's what trading is. Trading is pain. Just like the Buddhists teach us, life is pain. The only difference is the winners know how to transform pain into development and growth, and the losers take pain as suffering. And if you're not willing to take on that pain and use it as personal growth, you shouldn't be trading. The best advice I can give you is get these two books, The Market Wizards and the New Market Wizards. I'll put it in the chat. I think they're written by the same guy, by Schweiger. I can't remember his name. You'll see it. Just go into the bookstores. Those books changed my life. They didn't just change how I look at trading. They changed my life.
Wow.
And what's funny, it was about trading commodities, trading futures, trading options. And it's basically, the book is the two books are collections of interviews that the author did with famous and extremely successful traders. And there were about 42 or 44 rules that he came out of all those interviews, and he called it market wisdom / market wizardom. And if you want, I think I typed it up. I'll send it to you folks. But one of the things that was most important in there that almost every single trader said, and they always started off a little apologetically, they always said, look, I'm sure you've heard this 1,000 times before, but this is really important. The one word was discipline. And you can only be disciplined if you're willing to take the pain. Right? That's a hard thing to do. Right? That's what they taught us in the military, is no matter how hard it gets, no matter how painful it gets, you had to maintain a sense of discipline. Panic is one of the worst things to do. And that is exactly what happens in investing and trading. The two contradictory emotions can have the same bad effects: greed and fear. My position's going up. I'm really greedy. I'm so euphoric. I'm going to hang on. And then it reverses. Oh, shit. What the fuck have I just done? I just bet the farm on this one trade and it's moving against me. And I gave back $250,000 worth of profits, and now I'm actually in a loss. I'm $250,000 in loss. That's hard. That's really hard. You got to think about what you really want. I don't mean to beat a dead horse, but these are really important things that nobody talks about unless you're a really successful trader. So I'm not gonna give you specific advice about TA, technical analysis. I'm not going to give you specific advice about FA, fundamental analysis. I can give you some resources if you want, okay? Sure. But you need to really plumb the depths of your soul and think about that. And think about waking up at 2:30 in the morning because you just lost $250,000, even if it's quote unquote on paper. There is a sense of mania that happens, of going from euphoria to depression, or depression to euphoria. It really messes with the human psyche. Let me type a couple of things in here. Glassnode is a resource. They provide what they call on-chain analytics. And there's another one called chain analysis. They also provide on-chain analytics. And what that means, to put this in context, is the blockchain, the Bitcoin blockchain is roughly 500 gigabytes of information. You could create a database with an app on top of that to do your analytics through there. These companies have done all that for you, and they have a slew of metrics that you could take a look at. And it's like their version of Tableau, right? They have a whole suite of tools and tool sets you could use. So you could do TA and FA if you really want to. I still, to this day, I'm not even a trader, but I still do technical analysis and fundamental analysis because I just enjoy it. And it's just good practice, right? So if I anticipate the price of Bitcoin is going to go down and it goes down, it doesn't bother me. Why? Because I predicted it was going to happen. It doesn't bother me. And
Does
that's
it actually, do they actually allow you to short the positions, or is it only like the standard trading?
can you say that again, please?
Is it possible to short a position in Bitcoin or in any other
Yes.
Ethereum?
Yeah. I'm sorry. So yes, you can. So there are futures contracts for that. I think the CME has futures contracts. There are at least 2 exchanges that have futures contracts. This is the CME, the Chicago Mercantile Exchange.
Wait, Chicago Mercantile Exchange works with Bitcoin?
So they have what's known as a futures contract. It's a financial instrument. It's a derivative, basically. It's no different than the S&P 500 futures contract. It's no different than the cattle futures.
Wow.
Pork bellies. Yep.
Wow.
Yep.
So through the Chicago Mercantile Exchange and where else? Not any, or yeah, where else?
Just look up Bitcoin futures.
Okay.
So to answer your question, you can, but keep in mind, because it's a derivative, there doesn't have to be a hard tie between the Bitcoin price and the futures price. In fact, are you familiar with the concept of contango and backwardation?
No.
Okay. So in futures, you have in these markets, you have two things. You have what they call the cash market, which is the actual physical thing like gold or silver or cattle or pork. That's the physical market. It's called the cash market. Then you have the futures market. Normally, because of what they call carry costs, the futures price is going to be a trade at an average at a price that's a couple of percentage points higher than the cash market. All right. That's basically going to be a function of the interest rates in the open market. Okay. A few years ago, it was about 5%. And it would start at about, if you started maybe a year ago or a year before, it'd be 5% difference with it. You had futures high and cash market low. And over time, it would converge to zero. Okay. That's called your normal state, and that's called contango. Okay. If you actually have the futures price and the cash price, if it's the opposite of that, where the futures price is lower than the cash price, that doesn't happen often, but it does happen. They're called backwardation. I'll type them in for you. Contango and backwardation. And backwardation, kind of as the name implies, meaning it's backwards. The future price is lower than the cash market. So in the futures and in Bitcoin futures, that happens more often than people want to admit. There are times when the futures price can be thousands of dollars higher than the cash Bitcoin price, and it goes to be thousands of dollars lower. Keep in mind, there are options on futures, and sometimes the expiration and the exercising of the options affects the futures, and the futures affect the cash Bitcoin price. So if you get what they have called triple witching, where you have several option contracts expiring on a Friday for the month, and they're all getting expired and exercised, then they have to go to the futures market to buy or sell the futures. And that causes a huge disparity between the futures and the Bitcoin, the real Bitcoin price, and go all over the place. If you see, go ahead.
So can I get these options in the Thinkorswim, or is it something, should I go to a specific platform to get this, buy these options?
If you just look up Bitcoin futures, typically any platform that has Bitcoin futures, they will have Bitcoin futures options.
Okay, gotcha. Okay.
Do you know about, have you traded options before?
Yeah, I've done some basic caller options with the Thinkorswim, the TD Ameritrade account.
Okay.
So I have the basic knowledge about it. Yeah, not
Yeah,
much.
TDA might have that. I don't know. Yeah, so if you look up Bitcoin futures and Bitcoin options, you should see several exchanges that have that. Some of the strike prices on options are going well above $100,000.
Wow.
Yep. There are market makers out there that are up to 120, 130, $140,000. What other questions do you have for me?
I'm good. This
Great.
is my basic guide. This was the book, Abby.
Yeah. Thanks, Jay, for that.
Yeah, it's a great. I was telling Susie that there's a major difference between the Austrian school of economics and the Keynesian school of economics, and the Austrians always win. They're always right. It's just that nobody wants to admit it. But when I talk about the Keynesian school of economics, this is basically started by John Maynard Keynes back in the 1930s. And he was a British citizen who had a great deal of influence in American economics and politics in the 1930s and 40s. So the reason why I'm saying that is because in the book, the author, Saifuddin Amis, I'm not sure, takes the reader through a very logical and progressive, logical progression, I should say, of bad money versus good money, and then showing the bad effects, the deleterious effects of having bad money, and then also compares that to historical examples of when we had good money and how we had an enormous amount of prosperity. It happens every single time. Whenever a government uses good money, sound money principles, the entire society prospers greatly. And invariably, whenever a government uses bad money, it causes corruption for decades, sometimes centuries. And the Roman Empire is one of the best examples of that.
They were victims of bad money.
Yeah. So if you take a look at the pay for Roman soldiers, they were paid in I always forget the name of it, but they were paid in a unit of silver. It was a standard amount that they were paid. And what ended up happening was emperors and the government started to debase the currency. They started to put copper in the silver coins. And what that allowed them to do is basically issue more coins. Well, they artificially inflated the money supply. Well, that works for a little while, but after a while, the soldiers start to realize, well, my purchasing, sure, maybe I'm getting more coins, but my purchasing power is going down. So whereas before I could buy one loaf of bread for 2 of these silver coins, now it's taking maybe 3 silver coins. By definition, that means my silver coins are worth 50% less. And this happened over many, many years. They just kept inflating the money supply and deflating the purchasing power of their coins. And it wasn't just the soldiers, it was all the citizenry. It's just that the reason why it's important for the soldiers is because they were the might of the emperor, right? And after a while, they started to revolt. Say, oh, you don't pay me? You don't need me. And so that became a problem. So around the early 3rd century, early 4th century AD, Emperor Diocletian, this is kind of at the beginning of the major corruption of the Roman Empire. Emperor Diocletian issued a new form of currency for the Roman Empire called the solidus, and that's the etymology for solid is solidus, right? And this was, I think, 4.5 or 3.5 grams of gold, and it was what they call high fineness gold, meaning almost pure gold. And so that the Roman Empire respected that gold standard for years. Before that, they kept devaluing their money stock, right? But finally, Diocletian said, "Okay, this is it. We're going to issue this form of gold coin called the solidus." And it was so good that you fast forward a few years, Emperor Justinian of the Byzantine Empire was bragging, saying, "Our solidus is so good." And this is about 200 years after Emperor Diocletian issued this new form of money. So good that Emperor Justinian said, our solidus is used as in the Far East and the West in parts of Europe. It had what they call monetary hegemony. It was the apex form of money at the time. Okay. Fast forward a little further, right? Emperor Constantine IX, I think from 1042 to 1055, said, "We have so much power. We're so good. We can just start to debase the currency." Well, they took the thing that was supposed to be solid, the solidus, and they reduced it from 99% gold to 87.5 to 75 to 66 to 33. That's a 2/3 debasement. That means it took 3 times as many solidi, the new, as the old, right? That's massive. If you think about it, what if your paycheck were reduced by 2/3? What if the value for home were reduced by 2/3? That's huge. Well, the Byzantine Empire, because it went from being the Roman Empire to the Eastern Roman Empire, the Byzantine Empire. They had this in place for almost 800 years, and they really prospered. Well, Emperor Constantine IX stopped that, and they went into the dirt very, very quickly after that. And throughout history, we've had a series of empires or state powers that utilized sound money, good money for a short period of time, and they had the apex money for many years, right? So we can go through history. The Roman Empire had the solidus. Italy had the florins. Venice had the ducat. The Dutch had the guilders. The Spanish had the Rio de Ocho, right? The British had the pound sterling. The Americans had the greenback. These were currencies, money, real money, that were backed by gold and silver, right? Things that were actually had tangible results, and they couldn't just be produced arbitrarily. 1 pound sterling note was actually meant a pound of sterling silver, right? That's really important. Every single time that these empires got off of a sound form of money, their empire drifted along with it. And back in August 15th, 1971, President Nixon took us off the gold standard. And we have been on a decline ever since. If you take a look at what they call real wages, meaning wages adjusted for inflation, we have not, as a society, we have not gone up since 1971. Every single fiat currency, that's the type of currency where there's no tie to a gold or a silver or anything like that. Every single fiat currency ultimately goes to its true value, which is 0. And that's Frédéric Bastiat talked about that. He was a French journalist back in the 1800s. Because there's no real value associated with it. There's just an arbitrary value that government puts on it. Conversely, one of the best statements I heard, and I think it was by Stanley Druckenmiller, he was a famous hedge fund trader. He said, "Bitcoin has no top because fiat has no bottom." You can always make fiat currencies worth less and less and less. And history has shown that what happens usually is either the country goes defunct and their currency dies, or the country has to use hyperinflation, as we saw with the Weimar Republic, we saw with Zimbabwe, we're seeing with Venezuela, Argentina, Iran. Has had consistent 50% inflation per month. 50% per month. That's crazy.
And the saying was Bitcoin has no top and fiat currency has no bottom.
Bitcoin has no top because fiat has no bottom.
Whoa.
Mhm.
I'm preaching a little bit, but I kind of want you to get a feel for
Yeah.
what the book, the Bitcoin Standard talks about.
Mhm.
So the reason I'm saying this is because we can talk about the technicals, but if you're not comfortable with what Bitcoin is, if you don't know what it really represents in terms of its impact on the human race, then I don't think you'll have the motivation to stick with it. I think that's really important. And something I had said in my original presentation last year was, let me just finish this real quick, is that this is not a once in a generation event. This is not a once in a lifetime event. This is a once in a species event. This is really important. Now, we can also go to the broader topic of crypto assets, right? We know about Ethereum, non-fungible tokens, et cetera, et cetera, et cetera. Great, great inventions. They're amazing. And I'm still learning about them. But crypto assets and Bitcoin specifically is a once in a species event. I'm sorry, Avi, go ahead.
Yeah, no worries. No, yeah, that's exactly my question. So from I was wondering why there is this huge price difference between Bitcoin and Ethereum. Supposedly, I mean, Ethereum is supposed to have these smart contracts, and it is supposed to, grow eventually more, right? Like, is that a fair statement, or like what is what's the reason for the disparity between the price between Ethereum and Bitcoin?
They're just two different things. I don't think
Okay.
I don't think there's any way to make them equivalent at all. They're just
Right.
they
Okay.
do two completely different things. It would be like
Okay.
saying, well, why aren't Facebook and Google stock the same? Why is there a difference?
Got it. Okay.
And by the way, I'm still learning about Ethereum.
Okay. Yeah, these are really interesting. Like as you said, the NFT, NFT art, and all those things. It's like I think one of my biggest concern as a novice is, we are, for example, as a stock trader or an options trader, you know that okay, you bought something, you have it in your account, and you know that you can anytime you can have that liquidity of selling that in your fidelity and get the money back or whatever that is, right? So this part is a little bit confusing for me with the Bitcoin, because I said, as you said, I bought it in Coinbase. Now, what's the next step? So should I move it to my wallet and keep it there when I bring it back? Or let's say at some point I want the actual money, like USD, then probably I should bring it back, sell it, and then take the money out, right? So it looks like that is the process to go.
Okay, why would you sell Bitcoin other than emergency, like such an illness or death in the family?
Right. Yeah. So let's say I had some emergency, I wanted some liquid cash, and let's say my majority of my portfolio is sitting on Bitcoin, and I want to just liquidify some of that money, right? So that is one part. The second part of it was in terms of succession planning and things like that, right? Like, okay, at some point you want to hand it off to your kid or your wife or whoever that is, or at least have a plan for them to take over that. So that part also is not very clear for me, like how that works.
Okay, so to answer your first question, you would literally just set up an account with Coinbase. You would transfer the Bitcoin into your account, and then you can go in the open market and sell it. It's really simple. And then to get the money out, you would either have them cut you a check or wire you the money. It's just like any other stock account, right?
Okay, gotcha.
So the other part in terms of succession plan, that's a very good question. So there are a couple different ways you could do that. One is that you could maybe have an executor execute your will, right? And you just give them instructions. The other way that I prefer is you use a multi-signature wallet or multi-sig. And that allows two or more parties to be able to transact against that wallet. Okay. I'm gonna put something in the chat called Mastering Bitcoin, and this is by Andreas Antonopoulos. You can get this. It's a PDF. You can read it for free. PDF download. Andreas is an amazing individual. If I were you, I would follow him. He has a YouTube channel. He has podcasts, etc. He is a deep thinker, and he actually has his master's in computer science or something like that. So he literally read through the code, the Bitcoin code. He verified this on his own. He talks about multi-signature wallets in more detail, and it's pretty cool what Satoshi set up in terms of being able to do this. And you don't have to have every single person, every signatory on there to be able to transact. You can set up rules, so it could be majority or it could be unanimous, like everyone doing that. So it's pretty amazing. You could actually take the password. Let's say the password's 60 digits long, 20 digits to one person, 20 digits to the second person, 20 digits to the third person, and then you require a majority. You could do something like that, right?
Oh.
Yeah. If I were you, like I said, I'm a student of stuff. If I were you, I would literally look up Bitcoin wallets, Bitcoin storage, Bitcoin. What was the word you used? Succession plan, Bitcoin wills, multi-sig. So it would be MULTI sig or signature. You could put that on there. Yeah, and the cool thing about if you have a multi-sig is everything like in Bitcoin is programmatic, right? That's kind of cool if you think about it. Of course, then you have to think about the succession plan for the other signatories, right? That's not a bad thing. It's just risk management at that point. You need to think about that. Whether it's family or it's an executor, like an attorney or an attorney's office. So you just got to think about it. There are probably best practices out there. I'm not going to pretend that I know what they are, and I'm not going to pretend that I know what the risks are. But those are some of the basic mechanics.
Yeah, that makes sense.
Yeah.
So thumb rule, buy it through Coinbase, move it to your wallet. Whenever you want to sell it back, bring it back to Coinbase, sell it, and then you can take the cash.
Nope.
So, and succession planning is a multi-sig wallet. Okay.
Yeah. I think succession planning is important. You know, I make sure that my parents have a copy of my wallet and they have a copy of the keys. Right. So they can do it, even if they don't know the technicals of how to do it. They have all the stuff they need to unlock the wallet, and they can always bring a professional in to help them with that. Yeah.
So very slightly high level question, right? I'm hearing a lot of these startups who are working on saying that they're solving supply chain and they're solving some other industries based on the blockchain technology. Basically they're using the same concept of Bitcoin for extending it to other industries. Do you have any thoughts on that? Like what is can you give like a 10,000 feet view? Like what are they actually trying to achieve?
Yeah. So this is going to close in 3 minutes. So I'll just sign up. Okay. So. All right, let me give you the ultra high view right now. We are slowly moving from being a commodity-based, physical-based world where value is exchanged to a digital and information-based society where that's how value is transferred and exchanged, right? I think Bitcoin was the beginning of that, for, for obvious reasons, I believe that. And that's the lowest layer. The next layer would be, right, Ethereum and Cardano, right, ADA, right, stable coins, right, and then there are things like NFTs, right, non-fungible tokens. And Susie, just so you know, in a nutshell, non-fungible tokens, if you think about that, that's kind of the same thing as saying the rights for a Beatles song. Does that make sense?
Yeah, great analogy.
If you play a Beatles song on the radio, the Beatles are supposed to get a cut. Maybe it should be a penny, but they're supposed to get a cut of that, right? And so non-fungible tokens are a way of preserving the rights of the owner of non-tangible assets. That's basically it. Okay. In this case, it's artwork, right? But it can be applied to anything. It could be applied to a song. Anything is digital. Okay. So what we're going towards is a realm where we no longer have to depend upon the courts and the legal system and government and the legislatures and attorneys to protect our rights. Things will happen basically automatically. All right. I'm being overly simplistic. All right. Full disclosure on that. Right. There's a lot of work to be done. Right. But in the next 20 years, the world's going to be very, very different. Right. Because there are so many layers that are being built up vertically, and so many layers that are being built out laterally in terms of usability. Right. So layers in terms of function and lateral in terms of usability and the ability for the broader society to have access to this sort of thing.
I think we have 40 seconds left.
All right, I'm going to shut it down and I'll send out another invite.